Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. Welcome to the pod. Welcome to the podcast, Tom Howard. I'm super excited to have Tom on here.
Thank you very much, Mishkin. It's a pleasure to be here.
Yeah. So ever since I did a cross-border podcast with U.S. New Zealand, everyone keeps asking me, when are you going to do Australia? When are you going to do Australia? And I'm like, I'm going to get to it, guys. I'm going to get to it. I'm going to get to the good stuff. I just got to get to Tom. I've been targeting you for a while, Tom. I'm like, Tom's the guy. You got to get to Tom. And we're going to talk tax about U.S. Australia cross-border tax. Tom, why don't you give our audience a little bit of background about yourself, though? Give them just the 30-second pitch about your education, background, licenses, and one of my favorite firms I've ever visited, Pilot Partners. Just tell us a little bit about that as well, too.
Very good. Well, it's a pleasure to be here, and I'm very glad that you've done an Australian episode. New Zealand is great, but we'd say Australia's even better. Just to put the Trans-Tasman rivalry on the cards there. So a background to us at Pilot Partners. So Pilot is a firm that has a very long history. We've been Pilot for about 25 years, and we are a full-service chartered accountants firm here in Brisbane, in Queensland. So we're very fortunate, like you guys over in the States, to have a great firm here and a long history. But we do have we're a full-service chartered accountants firm. So we have everything from the classic audit, corporate advisory services, to forensic services, to specialist taxation services and business advisory. So we're a full suite, and we have a lot of cross-border clients, both inbound and outbound, be them individuals or families and their investments, or corporates coming or going from Australia. So it's a great firm to work at, and we've have the privilege of hosting you here. I think pre-COVID, it's going back a little while now, but we call ourselves, we're a chartered accountants firm. So for our friends in the States who may not be as familiar with that, it's more common in Commonwealth countries. We took a lot from the British system, and so it's similar to your CPAs over there. We have chartered accountants here. We also have CPAs here, but they're different qualifications. So to get that, you have to go to university and study a degree. I did 2 degrees, so I've got a Bachelor of Commerce and a Bachelor of Economics. And then you go and apply for a job. And thankfully, I've been here for a very long time. And you start your chartered accountancy, which is a formal qualification with assessments. It's a sort of a 3-year course before you can call yourself a chartered accountant. Plenty of weekend studying, that's for sure.
And at Pilot Partners, do you guys have CPAs, chartered accountants, and attorneys, or is it just chartered accountants and CPAs?
We're only chartered accountants.
Okay.
And so it's every graduate we bring on, we take them through the chartered accountants process and assessment. So the idea is we're all CAs, we call them, by the end of it. We don't have any attorneys or solicitors in-house. Okay. And likewise, we don't have any financial advisors or planners in-house or wealth managers. What we do is we pride ourselves on our relationships that we have both internationally, like with firms like yourself, but also across Australia, so that if a client needs legal advice or needs financial advice, we can make those warm introductions to people that we know and trust will do the best job for the client.
Yeah, I sometimes find myself like Grand Central Station, where I'm like directing traffic. I'm like, okay, well, you don't need an accountant, you need an attorney over here, you need a financial advisor over there, and I know you guys do a good job at that as well. You were a secondee. For those that don't know, the Wolf Group and Pilot Partners we're both in the what's called Nexia International Network. And Tom came actually to work for our firm for a couple months it's called a secondment, and he was a secondee in the secondment, which I think is a fantastic thing to do. If you have the opportunity to be a secondee in a network of firms, and you can go to a different country and see how their tax system works, and maybe prepare a couple tax returns or give some tax advice or whatnot. I think it's an interesting experience and helps you learn more about the other country. Do you want to just briefly talk about that, Tom?
Absolutely. So I was very fortunate to be able to get that secondment to the Wolf Group and come and work alongside you, Mishkin. It was pre-COVID, so we were lucky to get it in at the time that we did in 2019. But it all started because you had visited here at maybe 2018, I think, and you were doing presentations and a series of presentations here, and I was effectively in the right place at the right time, and an opportunity came up, and I grabbed it with both hands. And so I was very fortunate to spend a couple of months in DC with the Wolf Group, learning everything there is to know about US taxes. So I think I knew who to call, that's for sure, when my clients needed help on that side of the Pacific Ocean.
Yeah, well, I think it helps with issue spotting. So you get a client with a fact pattern, and they say I'm a U.S. person, and whatnot. I think it's really helpful for Tom to then just parse through it and say, okay, well, now what do you got to bring on? Wolf Group, Mish, Cohn-Resnick, whoever it is. I think that's super, super helpful. All right, let's switch gears. Let's get into. I'm sure the folks, the background is great, but the folks want to hear the good stuff. Let's go through some basics. And Tom, talk to me like I'm a 3-year-old. Or better yet, my 5.5-year-old daughter who wants to ask a million questions and doesn't really understand. Okay, let's start with the first question I have. How do you become a tax resident of Australia? What's the test? And then if you're not a tax resident of Australia, but you have Australian source income, do you still need to file and pay as a non-resident of Australia?
Okay, so first of all, how do you become a tax resident in Australia? There are 4 tests for tax residency here in Australia. You only need to satisfy one of those tests to be a tax resident. So actually ticking through them one by one is the process that you have to go through. So the first one is called the resides test, and it essentially looks at your life in full, and it places it on a weighing machine, and it looks to see, well, how strong is your connection to Australia versus your connections overseas. And so that looks at everything from where are your family ties, where are your business ties, employment ties, where are your investments, where's your residence, where are you really living. It goes down as far as drilling down into things like memberships, gym memberships, club memberships, golf memberships. It's quite forensic, that test. And at the end of the day, that is often the test that catches people. If you can get through that, if you don't satisfy the resides test, you move on to the next 3. And as I said, you tick the box in any one, you're an Aussie resident. And if you're an Australian tax resident, you have to pay income tax on your worldwide income here in Australia. The next test is called the domicile test, which is there's a very legal test. You acquire your domicile on birth. So Australians born in Australia have an Australian domicile. It's very hard to sever that domicile unless you really permanently leave Australia and have a permanent place of abode overseas. That's that's a complicated test, and there have been a number of cases through the courts around that test in proving your permanent place of abode overseas. The next test is the 183-day test, which is similar to one that you have in the States.
Right.
That is a counting exercise, really, to see how long you've been in Australia over a financial year. And if you've been here for more than 183 days, well, there's possibly an out there if you have a permanent place of abode overseas as well. And the last test of residency is quite a niche one, and that is if for members of what we call the Commonwealth superannuation schemes. So really this is to hold federal government employees within the Australian tax net, even though they may be posted to 4 corners of the globe. think diplomats, for example. That's a niche one. So most of the time we're talking to people about the first three. Yeah.
Yeah. Very, very common. The diplomats, even though they're in the foreign country, they're technically working on the soil of the consulate that they represent, and they're still a tax resident. It's funny because we have many of those clients too, and they're like, do I file U.S. taxes? And I'm like, no, you're still a resident of your home country.
Yeah.
Okay, so if I don't pass any of those tests, but let's just say I own a home in Brisbane, and so I'm in the U.S. I'm in Dallas where I'm at right now, and I sell that house. Am I going to be subject to Aussie tax on that house?
Yep. So if you're an Australian tax resident, I said before, you're taxable on your worldwide income, including capital gains. If you're a non-resident of Australia, you're only taxable here in respect of your Australian sourced income. And so that depends on the type of income, but it can get quite technical too. However, if you've got an Australian property that you're renting out and earning rental income from, you will have an obligation to file a tax return here and report your net profit or loss made on that rental property.
I see. But am I filing that as a non-resident, or it's just okay? Got it.
You're filing as a non-resident. You're subject to different tax rates. They're not as concessional. You're also not eligible to get as many concessions from our capital gains tax laws. Well, they work out okay for Australian residents, but most of the time non-residents can't vote. So it's quite easy for the government to collect a bit more tax on the non-resident side.
I see.
Without losing too many votes.
I see. And I think I heard that you have a withholding tax on sale for non-residents too, right? And I think that just went up.
We do. We have a withholding system. So for non-residents who might have shares, Australian shares, there is a withholding system on those.
Okay.
And likewise, if you're earning interest in Australia, there's withholding, or royalties from Australia, there's also withholding. And those withholdings are final withholdings. So provided you've got nothing else and the correct amount of withholding has been applied, you then don't have an obligation to lodge tax returns in Australia. The withholding occurs at source, and you just take your net proceeds.
Okay, very similar to the U.S. for non-residents. All right, let's shift into, I think, one of the biggest issues that I run across, or my clients run across, that are living in Australia, or have an Australian company or trust or whatnot. Does Australia operate on a calendar year or a fiscal year?
Well, this is where we like to be different. So we operate on a fiscal year. Our financial year runs from the 1st of July till the 30th of June. Okay. And so we're out of step with pretty much everybody globally. But I don't see it changing anytime soon.
I was having a funny teaser with the UK folks, because they just changed all their laws, and they were talking about doing foreign financial asset reporting to the UK on their fiscal year. And I said, well, yeah, but good luck trying to do that with Australia's fiscal year, or India's fiscal year, or even us in the US for calendar year. And
absolutely.
Yeah, it's a interesting take. Okay. So you're on the fiscal year, meaning that, when I talk to people and they say, well, what do you need for me to do my tax return? I'll say, well, to do your 2024 tax return, I need 2023, 2024, 2024, 2025. So basically I need 2 Australian tax returns to potentially do 1 US tax return. Now there's some ways to maybe kind of massage around that, or kind of find a way to streamline that a little bit. But let's talk about the Australian tax return. So if you're on a fiscal year, so you're July 1st to June 30th, when is the Australian tax return due?
Okay, so if your client is using a tax agent here in Australia, so a firm such as ours, then for most private groups, their lodgement of the return for the year ended 30 June, so we're talking about this current financial year that we're just about finished here in Australia, those returns wouldn't be due until either March or May the following year. So between March and May 2026. There are cascading lodgement times depending on the taxpayer and how much tax they paid in the prior year. So large corporates start having to report in January, and it goes all the way through to private groups that round out in May. If, however, they don't use a firm to prepare their tax returns, then returns are due by the end of October.
Oh, wow.
Following. So you don't have a long time frame if you're not using an accountant.
Okay. I guess I would then ask, does pretty much everyone use an accountant or to kind of push out the time frame, or?
That depends. In Australia, the system is not bad. If you're just earning salary and wages, there is an effectively automated system with the Australian Taxation Office that most people could prepare their returns online. Now, we operate a self-assessment system like in the States. So yes, a lot of people do that through a website called MyGov, which is the government website. And if there's any degree of complexity, then people would be using an accountant.
Okay.
In most cases.
I love that. I think that's great. I mean, I know that you may not know this, Tom, but the House, we're getting a new tax law here in the U.S., or maybe you do know that. I think I may have told you.
The big, beautiful bill, is it? Yeah.
That's the big, beautiful bill. And as part of the House bill, they killed the direct file, the federal government direct file program. So I love the fact, though, that for people that have a very simple filing, you don't have to use a third-party software. It's a big deal in the U.S. because, and I'm not going to name the tax softwares we have here, but they were basically sending people's information to Meta. So Facebook, Instagram, different kinds of social media outlets then had people's information. I think it should be like what you guys have. If we're going to do a system like that, it should be a free file direct with the federal government here in the U.S. And I don't see why you couldn't do that for a large majority of taxpayers. And it should. I almost believe that, and I know some countries will almost do the return for you, and then you just go in and check it, and then it's done, and you just kind of sign off on it. I think that they could do that too. I don't see why they can't.
Our data matching systems here are very good now, and so for people who are earning salaries and wages, they'll go into the MyGov website to prepare their tax return, and it will be there ready for them. So it'll have their total wage and their withholding and any allowances paid to them, and it's a process of checking and making sure that's right. Ultimately, the self-assessment system requires you to declare that everything in that return is correct, so that it's on the taxpayer there.
Okay. Let's talk about tax rates. So income tax, what's your income tax rates? Or generally speaking, you don't have to name all of them if you have a bunch of them, but what's the income tax looking like out there?
So for most of our clients, when we're talking about residents or Australian tax residents, most of the time we're talking about the top end income tax rate, and that's when does that kick in? We have a cascading threshold system, so the first $18,000 of income is tax free, and then the tax rates ratchet up from there. Now, currently, the top marginal tax rate is starting at $190,000, Australian dollars, I should say,
right?
And that is a marginal tax rate of 47%.
Okay.
When you include, it's 45%, but there's a 2% Medicare levy for hospital service and the Medicare.
Okay. Sounds similar to our 3.8% net investment income tax or the 0.9% additional Medicare tax. And what about capital gains? Is that a different tax rate, or?
So we colloquially talk about the capital gains tax in Australia, but it's actually not a separate tax. It folds into your income tax. There are different ways to calculate it, and it's subject to quite generous concessions for Australian residents. But basically, you put your net capital gain into your income tax return and pay tax on your marginal rate. Now, depending on the type of gain and how long you've held the investment for, you could obtain a 50% discount on your gross capital gain. Oh. And so that's what we call the CGT discount. Australians are very attached to that. There's always rumblings if it's too generous or whatever, but it's it would be a very bold call politically for somebody to remove that at this stage. So unlike the States, which is it achieves a similar result, but that we have a different way of doing it.
Okay, got it. And if there's income that you're getting in Australia that doesn't have withholding tax, in the U.S., if you're going to owe more than $1,000 on that type of income, you got to make estimated tax payments, federal, state, everywhere. Is that how Australia does it? Do you have advanced tax payments, estimated tax payments?
Yep. So very similar. Once you once you lodge a tax return with income that's not withheld at source, and provided it's over, a small threshold, the tax office, I call them the tax office. They're the Australian tax office. That's our IRS equivalent, I should say. And most people call them the ATO. So if I use any of those terms, that's what I'm talking about.
Yeah.
The tax office picks that up from the lodgement of the tax return, and you enter into what's called the pay-as-you-go installment system, which is effectively a prepayment of your annual tax bill. And that can be quarterly or monthly, but for most individuals and family groups, it's probably quarterly.
Okay. And
at the end of it, you true it up in your tax return, really.
Okay. And so now let's talk about the flip side of the coin. What happens? So in the US, if I don't file a tax return, technically it's a criminal act, although very rarely do they prosecute people on that. And most of the time they just do what's called a substitute for a return, just to force the income tax, to be assessed and for the balance to start going for collections. What happens if you don't? Do we see people not filing Australian tax returns or getting in trouble for any of those shenanigans or not making income tax payments, or what's the weather like down there on that?
Yeah. So if you're not required to lodge a tax return here because you don't earn any income or there's no withholding, you can lodge a form called a no return necessary. So it's not a tax return as such, but it's a notification to the tax office to say, I don't have to file a tax return this year. They can always review that, of course, and counter the argument. They have a lot of power. But if you've got an obligation and you're not lodging, or you're lodging and you're not paying, it won't take them too long to come knocking. And they're in COVID, in the COVID years, they were more lenient in relation to penalties that they would charge. At the moment, we're seeing a much more aggressive approach from the ATO to ensure that compliance is up to date, to ensure that collections are where they should be in their eyes. And so if you're lodging your returns and you're not paying, the debt accrues interest, and late payment penalties can apply as well. And there's specific arms of the ATO who are debt collection teams, and that is all they will do, and pretty good at hunting it down. I know, speaking a bit more colloquially, the US system, the US citizens seem to be a lot more scared, should I say, of the IRS than we do of the ATO. I don't necessarily think that that's warranted here. I think people are a bit more relaxed about the ATO than they should be, particularly now their data matching powers are very, very good.
Okay. Yeah. I mean, my viewpoint on it is the IRS and the ATO are kind of thick as thieves, and they're very similar in their approach to how they come at you with that. I think there's just been so many horror stories of IRS agents showing up and taking people's homes and doing all sorts of crazy things that, it's kind of percolated in our culture. My observation with dealing with the IRS over the last couple of years is they've gotten pretty decent at giving folks a good turn. As long as you don't try to abuse the system, they are pretty willing to work with you and give you a good turn. And, if you meet them halfway, I think you'll find a good result.
Yeah, here in Australia, if you haven't reported, or the other thing is the self-assessment system can get people into trouble too. For example, if I go back to the online lodgement of tax returns example, you might have completed them yourselves, but you might have missed some income, and those returns might have been filed 2 or 3 years ago, but you haven't fully reported your income. And if the tax office finds it first, they're not going to be as friendly. But if you go to them with a voluntary disclosure, which you can make, you're going to get a much better hearing, particularly on interest and penalties, and they're going to be a lot easier to deal with.
Okay. Same thing here. The IRS loves their voluntary disclosure practice. It's actually the podcast I did before you with David Warner. We kind of walked through all that together. Okay, let's talk about foreign tax credits. So this is a big misnomer for the U.S. because a lot of people will ask me, they'll say, well, there's a treaty, so I should be able to get a credit. My response is always, The credit is statutory. It's in the code. It's in the 900 code section. You don't need a, just because the country doesn't have a treaty doesn't mean we won't give you a credit. I have a two-part question for you here, which the first one should be straightforward. Second one may be a little bit of a hijinks for you. But does Australia allow foreign tax credits? One, and then number two, how does it work if you have someone that's on a calendar year basis, like in the U.S., where you're taking the tax paid and you're using your credit against the fiscal year taxpayer? That square peg in a round hole, if you will.
Yeah, absolutely. So the short answer is yes, we do allow foreign tax credits here. However, to be able to claim it, it needs to be a foreign income tax. So that's the first thing, particularly in the States where you're filing maybe federal state returns and potentially municipal as well.
Mm-hmm.
So it's only federal income tax that counts.
Okay.
Which leads into the next part is that income tax has to have been paid already on the same income. So you need to have the same taxpayer. You need to be taxable in respect of the same income in both countries, and you need to have been paid your federal income tax overseas before you can start to look and figure out how much of that foreign tax credit you can claim here. It can get quite complicated, but the Australian Tax Office realizes that we're not necessarily in step with our American colleagues in relation to financial years. So there is an allowance for the fact that you might be claiming a foreign tax credit in a tax return here that doesn't necessarily line up over there. So they understand that there's going to be a mismatch in timing.
Right. And I see it all the time where I see people that don't understand that, at least here on the US side. They don't understand it. And I get someone's return and I'm like, the Australian tax rate for this person is so high. It's higher than the US. I can't see why they would owe US tax on this. And it's because they're not understanding the difference between the fiscal and calendar year. And it's creating issues on the US side for how they're applying the credit. So it's a really important part because for the most part, the Australian tax should wipe out the US federal tax. It won't.
It should do, yeah.
Most state stuff, but for federal, outside of our net investment income tax, which is still a question mark in the air, it should wipe it out. So an interesting topic. Okay, last tax law basic question for you, and then we're going to move on to we're going to talk about individuals specifically. We're going to go into some scenarios. Does Australia have an inheritance or estate tax?
So the answer to that one is no. Historically, there were estate taxes in Australia, but they were state-based. And so probably I should give your American listeners a better understanding about our system here.
Sure.
We're very similar in a sense to you because we have states and they form a Commonwealth government. So each state has its own government. Each state can levy its own taxes. However, they granted the power to levy income tax to the federal government in the last century. So income tax is a federal tax, likewise capital gains, but the states do still levy payroll tax on business. They levy land taxes and stamp duties or transfer duties, they call them.
Yeah.
So estate taxes used to be a thing here, and they got phased out. The state I'm in, Queensland, phased them out in the 1970s and 1980s, and then progressively the other states did likewise. So there's always rumblings, will one government bring them back or not, but it would be pretty hard to do that politically here at the moment.
So let's just say I own Apple stock and I bought it for $5 and I pass away and you inherit it. Does your basis take the fair market value at the date of death, or do you take my basis at $5 since you have no state tax?
Depends on when you purchased it. Generally, the idea is that assets will pass from the deceased to their beneficiary in a tax neutral way.
Okay.
That's the general idea. There are exceptions to that depending on what the asset is. But for shares, for example, stocks, you will generally inherit the deceased's cost base, what we call cost base, you call basis. So that could go back a long way, and you could inherit a very, maybe it's worth a lot of money, the stock holding, but you've got a low cost base, so it's pregnant with a large capital gain. That capital gain doesn't come home until you dispose of that stock.
Okay, love that. I'm going to steal that actually, Tom. The next time I talk to someone about an asset that's highly appreciated, I'm going to use that term word for word. So okay, let me ask you this though. Let's say it goes back a long way, and the individual's like, I have no idea what my father paid for this. Do you use a value of zero? I mean,
So if we're going back past 1985, that was the year that the capital gains regime came in Australia.
Right.
So before that, we did not have a capital gains tax. And so if your father, for example, purchased stocks in 1980 and still had them and then passed them to you through his estate, then you would be deemed to acquire those stocks at their market value on his date of death. So that's when they enter the capital gains tax regime.
Okay. I really like a lot of the things you're saying. I really wish I could have members of Congress kind of tune into this podcast. There's some really good ideas here that we could.
Well, hopefully they are.
We should steal from the Australians. Okay, let's shift to individuals. So, walk me through. It's a running joke in the U.S. or at least in my firm that someone gets on the plane to Australia. They land, they move there, they're inbound into Australia. Someone walks up to them, gives them a superannuation fund, 3 trusts, 3 P2I limiteds, and then their U.S. tax return explodes. But I want to understand and we'll talk more about that here in a minute. We'll get into all that stuff. But from your perspective, U.S. person X walks off the plane, and they've got all these U.S. based assets. What are some common issues you're seeing from a U.S. individual inbound into Australia?
Sure. So you're right. I mean, your analogy is almost correct. When you permanently relocate here to Australia with the intention of living here, and you, for example, you bring your family and your life relocates here, your tax residency does start when you get off the plane.
Mm-hmm.
Now, as for whether we hand you a superannuation fund and trusts, we'll get into that later. But the important thing to remember is that you're entering the Australian system at that time. Mm-hmm. And so if you would never had anything to do with Australia previously, then basically all of your investment assets and your offshore assets will be deemed to have been acquired on the date, at their market value on the date you came to Australia or you stepped off that plane. So a really important thing is for someone coming to Australia inbound, and they might have a property in the US and plenty of stocks, get a market value of those current as of the date that you step off the plane and permanently relocate here, because that will be the starting point for our capital gains tax regime.
Oh, that's a great tip. I love that. What else?
If you're coming here, from the States, you're probably coming here with a 401k or a Roth IRA. And these are all things that we hear about in films. And in tax practice, we need to figure out how they work from an Australian system. Let's just say that neither country treats either's retirement savings that well. We don't fully understand each other's retirement savings system, and so we can put it through some nasty hoops to jump through. So from our perspective, they are mostly going to be classified as foreign trusts, IRAs and 401ks. And the process there is quite difficult because we have this old provision of our tax legislation that was designed many, many years ago to stop people harboring wealth offshore in foreign trusts. And it's quite draconian in the way that it works. People can or have referred to it as the Temple of Doom for Indiana Jones fans.
Love that.
It can be nasty in its application, but the idea behind it was it's trying to stop people putting a lot of money in trusts in the Cayman Islands or some tax haven and accumulating a lot of income outside of the Australian tax net and then benefiting from that in some way, whether it's drawing the cash out or taking a distribution or a loan. The idea is you're taxable on any income that comes to you in that form of a benefit. And if there's any accumulated income there, then that's taxable as well. And there's a really nasty interest charge to compensate the Australian Tax Office for the lack of income reported over the years. So if you're coming here with an IRA or a 401k, on the time that you arrive here, get a report from your provider as to the contributions that you have made into those funds, because that will be counted as the capital of the fund, and withdrawals of capital are not taxable. And separate to that, if we could get a breakdown of the accumulated income thus far, and then ongoing, that will give us an idea of, okay, when you draw money out of those, when you retire, exactly what is taxable, because the original contributions are generally going to be considered capital, and their withdrawal won't be taxable here.
Oh, like a return of capital. Okay. Got it. Very cool.
Yeah.
And I will tell you that I'm going to have to teach you guys about a brand new account, because the House bill they just changed the name. It was called a MAGA account. It just changed. They decided they wanted to change the name to a Trump account. So there could very well be a new account in the list of accounts that we'll have to educate you guys on.
I look forward to hearing about this. Does it come with a hat?
It may come with a hat. It's meant for children, though. So basically, you open it up for a child less than 8 years old, and then they have to distribute all the funds by the age of 30 for either education, their first home, or for a business club. But it's an interesting. Yeah, it's an interesting account. It's definitely a trust. It even says at the beginning, this is a trust. So it would fall into your foreign trust scheme. Let's talk about the other side of the coin here. Let's talk about Australian planning structures, and this is where U.S. people get in trouble on the U.S. side, because, and I get this question commonly. Well, what if we had the person with the trustee here, but they had the power there? They're trying to move the U.S. spouse on the board somewhere so they can still have, some kind of powers. And tell me about the planning structures. Tell me about the trusts, the PTY limiteds, all that good stuff.
Okay. So as you pointed out, we have a love affair here in Australia with trusts and private companies. And so trusts, from an Australian perspective, we pinched a lot from the British. We pinched their system of government, their legal system. We also pinched their concept of trusts. And so trusts are used very, very commonly here, either as investment vehicles or as vehicles for business to operate out of as well, for smaller business, really. But it's a common investment structure. And it's not a separate legal entity in itself. The trustee is the separate legal entity, and it is the controlling mind of the trust. But it provides a level of asset protection, and it provides a level of discretion for the trustee to distribute the income and gains of that trust. And they're very flexible, and they can lead to good tax outcomes here, hence why they're so popular with Australians. However, when we've got a US citizen in the mix, it can get nasty, particularly if that US citizen is all over the trust. We have different positions in the trust. So the common one that you're going to hear about is the trustee. The trustee is really the controlling mind of the trust, and makes the decisions as to how income and capital are distributed, how the capital of the trust is invested, which beneficiaries are to be made entitled to income and capital from year to year, and so on and so forth. So the position of trustee is a very important one. The trusts that you'll mostly see in Australia are called discretionary trusts. So nobody has a fixed entitlement to any of the assets or a fixed interest in any of the assets. Their benefit, provided they're able to be a beneficiary under the trust deed, whether they benefit from it or not depends on the discretion of the trustee. Okay. And so people can't say, I own 70% of that trust, because you don't own anything as a beneficiary.
I see.
There are different types of trusts. Sorry, but that's the most common.
Okay. Just want to clarify though. It sounds to me like what you're saying though is that the trustee has a lot of the powers of the trust and enjoys those powers. We say in the U.S. enjoys the powers of the trust, kind of like He-Man, right? So sounds to me like that's the person that you would look to say, because there's a settlor or a grantor, right? And there's beneficiaries, but it sounds to me like the person really kind of operating the entire thing is going to be the trustee.
Generally so, yes. And yes, the settlor is the person who originally settles the trust, but that's commonly a solicitor who's not related to the family group or whoever controls it. And there's also another important role called an appointer or a principal, who has the power to remove the trustee. Now, usually in a family group setting, the trustee is commonly here in Australia a private company in its own right. A company can act as trustee, but often everything's controlled by one family. And so you've got a private company and mum and dad might own the shares in that and be on the board of that company. And that company might not do anything other than act as the trustee for their discretionary trust.
Yeah, and this is really important, I think, for the U.S. folks to understand. So in the U.S., we're very similar to what Tom described with the Cayman Islands. We don't like people setting up trusts and accumulating income and deferring it. Deferral is a dirty word in the U.S. tax code. We want all tax paid on income earned annually. No deferral shall be allowed unless it's qualified under the U.S. tax code, et cetera, et cetera. But there's two flavors of ice cream when it comes to foreign trusts in our world. There's the grantor, there's the non-grantor. And I think what a lot of people miss is that they try to apply our U.S. definitions to what they're seeing on paper for these trusts. The settlor, that's the owner, that's who owns it, so it's going to be a grantor, non-grantor. You really can't go that way. And I would tell a lot of folks that are tax practitioners, when you're doing your analysis of an Australian trust and the PTY limited trustees, you're not looking at Internal Revenue Code 679. You're looking rather at 671 through 678. And you really got to line it out, put it into a little chart. Who's got the power to do this? Who's got the ultimate power to do that? Like Tom said, there can be layers of control. And if you need to ask, you need to dig down deep and really figure out the way that it's working from a practical perspective. And then from there, you can determine, is it grantor, is it non-grantor? Some situations are pretty straightforward. And then, we get right to it, like, oh, it's definitely grantor, it's definitely non-grantor. But some of these things you really got to parse your way through.
And it really requires collaboration between advisors. So, Mishkin, you and I have worked closely on a number of these, and it makes it a lot easier.
Absolutely. Let's talk about the PTY limiteds, though, when you guys are actually using them. And I want you to kind of explain a term which takes a lot of people by surprise, which is the here in the U.S., we don't have this, but a franked or franking dividend.
Yep. So PTY Limited is a private company here in Australia, a proprietary limited company, commonly used as business vehicles here, very, very commonly. So it earns income, it pays tax at the corporate rate. Now, our corporate rates change depending on the size and scale of the business. It's either 25% or 30%. But the company pays income tax at that rate on its profits. And when it pays its tax, it gets what's called a franking credit. That franking credit can be passed out to its shareholders attached to dividends, such that if I had a company that earned income and paid 30% corporate tax rate, then it pays a dividend out to me and it attaches a franking credit. And if it was $100 of profit, it paid $30 tax, it pays a dividend, which would be the net, so 70 to me, but it attaches a franking credit. Now, the franking credit and the dividend are assessable to me here in Australia. I need to include both of those in my tax return. So my income, my taxable income is $100. I pay tax on that at my marginal rate, but the franking credit then can be used to reduce my tax payable. So if I was on the top tax rate, 47%, I'd pay $47. Well, in the calculation, it'd be 100 by 47%. So $47, take off the 30 that's the franking credit. My top-up tax is $17. So people in Australia love franking credits because they can be they can be attached to dividends so long as the company has paid income tax along the way. And this can apply from big listed companies to private companies owned by a family group. Franking credits and their refundability probably goes right alongside super funds and trusts and capital gains tax concessions as things that Australians do not want to give up.
Yeah, I bet. And it sounds fantastic. I mean, it really does. I will say though, from the U.S. side, we do not like franking credits. We don't give a foreign tax credit for those. And people always are like, I can't believe it. And I'm like, nah, it's unfortunate. It sounds like a great system. It sounds like it should match up, but we just don't do it. It's just not. It doesn't comport with the way our tax code works. You can't take a credit for something that a corporation paid for you. It's mismatched.
We're very attached to them here.
Yeah. No, I 100% get it. The other thing that I want to alert people to is that the PTY limiteds generally will fall into the control of foreign corporate rules. If you want to learn more about CFC reporting, go back to my very first podcast with Austin Carlson, where we talk about the dreadful Form 5471, which is the worst form ever created, and the associated guilty tax and transition taxes. But that's generally what you're going to get with a PTY, with an actual operating company. Now, with a trustee company in the trust format, you may be able to claim it's dormant, and you don't have to worry too much about that. But for an actual PTY limited, and in some cases, it's just a crazy complex form and the fees, and that's all you're out, because Australia tends to have a higher corporate tax rate than the U.S. does, and so that gets into our what's called guilty high tax exception. But still, it can create a lot of problems, and there are options to think about with PTY limited, such as check the box elections to perhaps treat them as foreign partnerships or foreign disregarded entities. But that can create a whole host of issues that you need to think through if you're going to be the owner of a PTY limited. And you should just really understand the data points of what you're getting into from both the fees, complexity, kind of an annual merry-go-round of what that's going to look like, and potential tax consequences, although I don't think it'd be that much with it if you can get the guilty high tax exception.
Absolutely. And it's very common to see structures with a lot of trusts and a lot of companies or private companies, PTY limiteds, in them. And they can be, an A3 page of paper. There wouldn't be much room left on some groups. And so if there's a US connection in there, it's going to be costly in terms of what you're filing overseas. And it's going to be hard to tick through it at first instance.
Side question before we move on to the next topic: does Australia allow folks to deduct like legal fees, accounting fees, those kind of things from their tax return?
Yeah, so it depends on what they've been incurred for. Generally, if the rule is that it has to be incurred in relation to earning assessable income for individuals.
Yep.
However, there are specific deductions allowed as well. So your cost to get an accountant to prepare your tax return and or advise you in relation to your tax matters is specifically deductible here in Australia. In relation to legal fees, that one's harder for individuals to claim. But for businesses, then they need to look at, well, was it connected to the business and necessarily incurred for the business? Because the big risk are that they are of a capital nature and therefore not deductible.
Okay, got it. All right, let's go to the was it the 72-pound gorilla, 100-pound gorilla? I forget what the phrase is called. Tell us, what is a super? Act as if again I'm a 3-year-old. What's a superannuation fund? This is a very foreign concept to a lot of U.S. people. Tell me about how superannuation funds. What is a superannuation fund? How does it work? What's its purpose? How's it taxed? Give us the deets, as the kids say.
Sure. So the superannuation became compulsory here in 1992. So it's a forced retirement saving for salary and wage earners, employees, similar to in concept similar to the 401ks in that. Although they're much less flexible here in Australia. So if you're an employee, a part of your package, salary package, must go to superannuation. At the moment, that's 11.5% of your wage has to go into superannuation. Super funds or superannuation funds can come in many different shapes and sizes. Some of them are very large industry funds, for example, Australian Super, and others are private, and others are self-managed. You can have self-managed super funds. So family groups will if they've got a bit of wealth, then they commonly will have a self-managed super fund to allow them a bit of flexibility in what they invest and how they manage their retirement savings. It's a very protected space. So once money is in superannuation, it's very difficult to get it out of superannuation before you meet your retirement tests and thresholds. And so you can operate on the basis that it's going to be locked up for a very long time. However, once you contribute money into super, it is concessionally taxed. So you can claim a tax deduction for the contribution into superannuation, and funds that are contributed into super then subject to lower rates of tax. So for most people who are yet to hit retirement phase, their income earned on investments in superannuation is subject to tax at a rate of 15%. That is very favourable compared to our marginal rates for most people. When you reach retirement age and retirement phase, and there's a number of tests that you have to get through there, the earnings on your superannuation account are actually not subject to tax anymore. So there are quite generous tax concessions allowed for superannuation. And then when you're in retirement phase and you draw out your superannuation, that's not taxable either. There can be taxable events. For example, if you were to pass away and still leave a lot of money in superannuation to your estate and your beneficiaries, there can be tax implications that aren't very well known or publicised for the beneficiaries of that estate. They can be subject to a level of income tax on the superannuation savings. So it's highly protected, it's highly regulated space. The idea that you can control your own superannuation fund via a self-managed super fund appeals to a number of private groups. And so quite commonly, you will see private groups have self-managed super funds. So instead of having a large entity in the States operate your 401k, you may be operating your self-managed super fund here with your retirement savings in it. Now, there's administration costs. It needs to be audited each year. They need to file tax returns and the like. But superannuation is a beast unto it. We could say that for sure.
Okay, excellent. Yeah, I mean, on the U.S. side, I will tell you that, well, I guess I have one question before I talk about the U.S. side. Can you do a rollover of, let's just say I'm in a big industry fund and I want to switch to a different industry fund or something like that, like a different provider. Is that considered a rollover, or am I just, because you're saying it's so highly regulated and tight and you can't take it out, right? Are you rolling that over, or are you just switching providers? Give me the lowdown on that.
Yeah, you can roll from one to another. That's certainly possible. So if you, for example, had a self-managed fund, if you had a self-managed fund that you no longer wanted, you could roll those funds into an industry fund. Now, there may be some taxes realized along the way from realizing assets, but the cash ultimately can get rolled over into an industry fund or a retail fund.
Okay, got it. So in the U.S., one thing is we don't like rollovers or foreign rollovers. That's a bad thing. It's got to be qualified under the U.S. tax code. So if you try to roll it over and you're a U.S. taxpayer, you could be creating what's called a foreign grantor trust, and then we're going to make you file forms 35, 20, 30. It's going to be a beast. The superannuation fund, from what you're telling me, sounds a lot like our Roth IRA, and it's really weird that I think the tax treaty. It's always my It's one of the last things I always pray for. The U.S.-Australia tax treaty will be updated, and it'll match up. And it's so crazy to me how like it's not taxable when you withdraw it in Australia, but it certainly is taxable here in the U.S. And then lastly, the self-managed superannuation funds create a whole host of problems for residents and even just Australian people in the U.S. Because for the residents, you're looking again at foreign grantor trusts, or even in some cases splits, where we're seeing one self-managed superannuation fund that's both grantor and non-grantor. So it's a crazy double filing because you have a U.S. citizen married to a non-U.S. person, an Australian national, and so then it becomes really interesting. The craziest thing I've ever seen in my life, and I can't recall if your firm referred these guys to us, but I've seen it now several times where people have come to me, they're Australian nationals, and they're like, I bought a property inside the U.S. through my self-managed superannuation fund, and I sold it, and there's withholding tax, because we have withholding tax called FERPTA, and I'm like, my mind is blown. I'm like, wait a minute. Who had the bright idea to have this superannuation fund buy a property in Missouri, in Tornado Alley in Missouri, and put that into their I mean, it was literally like shocking to me that this could actually be done, but it is. And I guess a lot of Australians like to invest inside the U.S. and through their superannuation funds. And
the general tax concessions available in superannuation are really attractive, and so it's not uncommon to see self-managed super funds with large property holdings, because Australians also, you could add in trusts, private companies, superannuation, you could add in property, because we love investing in property here. It's not uncommon to see property holdings inside self-managed super funds. Ultimately, capital gains that are made in respect of assets held for more than 12 months, eligible for the 50% CGT discount outside of super. Inside of super, the discount is a third. Oh. So it's a little bit different, but effectively you pay 10% capital gains tax on disposals of long-term investments within super. So it's pretty attractive.
Yeah, sounds like it. Okay, second to last question. Yeah, go ahead.
Sorry. Just round that out by saying it's getting more difficult to put money into super and large amounts. That there's currently a fair bit of debate going on. The current government wants to effectively cap how much can be put into super by applying a pretty nasty tax on unrealized gains at above $3 million of funds in super. So we do not tax unrealized gains from a CGT perspective, but they're trying to introduce it into superannuation. So tax professionals are jumping up and down at the moment to say, this is the thin end of the wedge. So watch this space.
Okay, yeah. Well, we may have to have you come back on and tell us all about that, and maybe we'll do just a full deep dive on supers in general, because there's a lot to unpack there. We're basically touching it with a needle at a very, very high level. Okay, second to last question, and then we're going to wrap up here. I believe I'm almost certain when I was at your office, we were talking about a client, and I think Murray Howlett or someone said, we'll get an answer from the ATO. And I'm like, okay, how long will that take? And he's like, I'll have it for you before the end of the day. And I'm like, what? Huh? And he's like, yeah, we just call him up and we talk about it. We get the answer. And I'm like, you're kidding me. It would take me like, a year to get an answer from the IRS. Is it true? Is it that easy to deal with the ATO? Is it just a matter of picking up the phone and calling him and say, hey, this is my client, they're taxpayer X. I got this problem. What do you think? Tell me about dealing with the ATO.
On certain matters, they're easy to deal with and you can get them on the phone. They're more along the lines of you're seeking a remission of penalties or maybe some interest that was applied, or quickly finding a past filing.
Okay.
We can call them. We have a tax agent hotline that you can call them and get someone there straight away. As for how helpful they are, when you get more complicated questions, that's not really what we go to them for. That's, we would provide advice based on the legislation and case law here. Now, if there was real uncertainty and a real grey area, there is an ability for clients to lodge an application for a private ruling with the tax office, and that's it can be a lengthy application. Depends on what the topic is that you're asking the tax office, but they will ultimately rule on a matter of law and bind themselves to that decision. So if there's a question that's significantly grey and the client wants absolute comfort, that would be the way to go. Now, those matters, generally because they're more complex, take some time to prepare the private ruling application and lodge it. It then takes the ATO some time to actually process it and come to their ruling, because quite often it goes to an internal legal team and they confer with other teams, and it can be a lengthy process. At the moment, we're seeing those take about 6 months for a private binding ruling. But the benefit is, at the end of the day, if the Commissioner of Taxation rules in your favour, the tax office is bound to that decision. So they can't change their mind later, provided that you've given them the complete facts and that it is accurate.
Same here in the US, but I don't know about you guys, but the IRS will charge you like $50,000 to do that. So I don't know if there's a fee.
There's no fee from the tax office. So
it's beautiful.
Any taxpayer can lodge it. But the way we do it is we would spend a fair bit of time compiling that application and then applying the legislation such that it really answers the question for the tax office, with the idea being that the tax office can then get the application and then check our reasoning and hopefully agree with us at the end of the day.
Yeah, I mean, the fees to prepare are always going to be, but see, here in the US, it's the fees plus the fee to the IRS. And so sometimes
we don't have it. The tax office doesn't charge you to lodge.
Yeah. Okay. So, we're at the end here, and Tom, you've been fantastic. I'm loving the discussion and everything that you're talking about. I think this will be super helpful for a lot of people. Tell the audience what, if they want to come talk to you, they want to come have a consultation, or they need tax preparation services, all that jazz. We're going to put the links to get in touch with Tom, Pilot Partners, Nexia, all that stuff in the show notes. But just generally, let's close on a quick 30-second. What happens if they want to get in touch with you? What's the best way to do that? How do you guys work?
So reach out to us via email is probably the best way, and you'll share those details, Mishkin. Otherwise, call on the phone line is fine, and we will set up a meeting, a consultation, a phone call, a Teams call, however it is best to work, and we'd be absolutely happy to help you.
Awesome. Well, Tom, you've been so fantastic. Thank you so much for coming on the show. We're definitely going to have you come back on, give us an update on what's happening out there in Australia, and we'll definitely see you next time.
Pleasure. Thanks so much for having me, Mishkin.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.